One question has plagued all crypto investors since the beginning of time. Should you invest everything at once, or slowly over time? Also known as DCA versus lump sum. Which is better? Well, the truth is, it depends. And today, we're going to cover both strategies, the pros and the cons. Which one is better, and why? But before we get into that, let me ask you this. What would you do if you had $10,000 to invest right now? Would you buy all Bitcoin right now? Would you buy some now and then dollar cost average the rest? Or would you wait for a dip and then buy more? In other words, what would you do with your first 10K? Let us know down below in the comments section. If you're new here, welcome to our channel, where we talk all things cryptocurrency investing. Before we get started, please make sure to like, comment, and subscribe. It really helps us out, and if you have any questions about anything mentioned in this video, please drop them in the comments section below. Now, let's begin. First up, let's define each term. A lump sum is simply when you invest a large amount of money into an asset all at once. For example, if you invested $10,000 all at once, you could check in periodically to see how your investment was performing, but you wouldn't need to monitor it closely because you only had one entry point. The opposite of this is known as dollar cost averaging, or DCA. This involves breaking up your larger investment into smaller chunks and investing that chunk at regular intervals. So instead of buying all at once, you'd buy a little bit every week, month, or year. A lump sum has its pros and cons, just like any other investment strategy. If you're right about the market, then it can be very profitable. However, there is a big downside. You have to be right not only about the asset, but also the timing of your investment. That's why it's called putting all your eggs in one basket. If you time it right, it can be very rewarding, but if you don't, you might be left holding the bag. So when does DCA work best? Well, when the market is unpredictable. By spreading out your investments, you are removing the emotion from investing. Since you won't be buying all at once, you'll avoid the feeling of panic selling when the price drops. When the price goes up, you won't feel like you're missing out. Instead, you'll stay calm and keep buying like normal. This will allow you to take advantage of volatility by buying low and selling high without even thinking about it. Okay, so far so good, but how does each strategy compare? We've got all the numbers on the screen here, and to keep things simple, we're going to run a few case studies. We're going to use Bitcoin, because it's the largest crypto by market cap, and it's also the most volatile. This means the results should be relatively extreme, making it easier to understand the pros and cons of each strategy. The purpose of these case studies is not to tell you which coin to buy, but rather to demonstrate how each strategy works and what you should consider when choosing one over the other. So let's get into it. All of these charts assume you start with $10,000 worth of fiat currency and invest it into Bitcoin. Our first example begins January 1st, 2020, when Bitcoin was around $8,000 per coin. We're going to break up your $10,000 into 10 equal parts and invest it evenly over the course of the year. Your first buy would be in January, purchasing 1.25 Bitcoins. Then, in February, you'd do it again, another 1.25 Bitcoins. And we'd repeat this process until December. By the end of the year, you would have purchased 15 Bitcoins. It looks like DCA lost, right? Well, hold on. Let's fast forward 5 years and see how the portfolios stack up. Here we are 5 years later, December 2025. The lump sum investor is still holding their original one whole Bitcoin, which is now worth $512,000. Pretty impressive. But what about DCA? Well, remember, you made 10 investments over the course of the year. All 15 coins were worth $765,000. So in this scenario, DCA wins. In fact, let's take this a step further and extend the chart to 10 years. In this scenario, the lump sum investor has seen their one Bitcoin grow to $1.3 million, which is a staggering return. But that 15 Bitcoin DCA portfolio is worth over $3.7 million. So DCA wins again. And this is the power of compounding. Even though you would have had more initial losses along the way, you would have bought more Bitcoin at lower prices. Then, when the price went up, you would have profited even more. However, this doesn't always happen. If we go back to the beginning of 2018, we would see a very different result. So which is better? Well, it depends. There are two main factors to consider. How much can you afford to lose, and how long can you hold? If you're okay losing some of your initial investment and you can hold for a long time, then DCA is probably the best choice for you. Conversely, if you're looking to invest a large amount of money that you could unafford to lose, and you're okay taking the risk, then the lump sum strategy may be better. You might be wondering, is there a perfect solution? Well, the answer is yes. The most optimal strategy is actually a combination of both. This is called the conviction-based approach. It's when you put a majority of your funds into a long-term hold. Then add small amounts regularly to take advantage of dips in the market. This approach is ideal for most investors because it provides a healthy balance between risk and reward. What about timing? After all, isn't timing everything? Not necessarily. There is no way to consistently predict how the market will react. The reality is, the market is too complex. There are too many variables and too much volatility. If you try to time it just right, you may end up doing more harm than good. Which brings us to the next factor, behavior. Have you ever sold too early and missed out on bigger gains? Have you ever held on too long and locked in a loss? How about when the price goes up? Are you tempted to sell because you think the market is overheated? These are all examples of emotional investing. Many investors have experienced this, and it can cause a lot of problems. If you can keep your emotions in check, then lump sum can be a great strategy. On the other hand, if you are prone to make impulsive decisions when the markets are volatile, then DCA may be a better fit. In this case, you can think of DCA as an investing crutch. It can help level out your gains and prevent you from making impulsive decisions. Some people believe that DCA is a form of market timing, and it kind of is. However, there is a key difference. With DCA, you are not trying to time the market. You're just taking advantage of opportunities as they present themselves. This gives you more freedom to be opportunistic without being impulsive. So what's the bottom line? Most investors will be better off using DCA, especially if you're new to investing, or if you have a hard time controlling your emotions. However, if you're an experienced investor who has a strong track record of making smart decisions, then the lump sum strategy may be a better choice for you. Thanks for watching. We hope this video was helpful. Please let us know what you thought down below in the comment section. And remember to subscribe for more guides.